And we do the same thing. We withdraw the money from the bank and buy the asset, take that cash flow and put it back into the bank. We call this the cash cycle of investors. What we're saying with infinite banking, we're not changing what you're doing. We just want to change how you do it, because all we're really talking about in the simplest terms is where you store the money.
Is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today is a proud U.S. Army veteran, and he's a self-described recovering CPA. He's worked with the world's largest accounting firm and served as CFO of a chain of restaurants. After 2008 recession, he realized that financial freedom would never be found in the latest Wall Street created financial product. He teaches and coaches individuals and business owners about money and investing. So his name is Anthony Faso, and Anthony goes into ultimately infinite banking, right? I know a number of you have heard of that. We've done a few shows on it with other people in the past. It's been a bit though. And so I, though, get questions often about this from our investors. And so I appreciated being able to talk through this again, here Anthony elaborate as an expert on what this is, how it works. I think he's a good resource for us and for you. But he also provided a link at the end that will give you free access to a course that he created. And it's consultants.com/the real estate syndication show. So I know that's really long. We'll have it in the show notes, but I want to go ahead and give it to you up front so you can check that out. I'm not compensated for that in any way. However, I just know that I get a ton of questions around infinite banking often from our investors. And this course that he created, I feel like would probably answer a lot of those questions. So you can determine, is this a good fit for you? Is it not? I ask him some questions during the show about, hey, who is this not for, right? And what are the risks? And he elaborated on a number of things that you need to know, right? Before you do this. There are a couple things that may not seem positive to everyone, but it may be okay as well, depending on, where you're at in your investing journey. One of our goals at the Real Estate Syndication Show is to add as much value to our passive investors as we possibly can. And I know recently I've had a number of questions. I would say even over the past 2 years, I've had a number of investors reach out and say, "Hey, Whitney, have you heard of this thing? Is this something? Is this a scam? Is this something I should be aware of? What is this?" Right? A number of you have heard a few shows we've done. It's been a little bit though, and I bet there's some things our guest today is going to bring to light that I know that you want to be aware of as an investor. And as you're planning that, hoping we're all trying to reach that financial freedom number, right? And this may be a method that may work for you. And I want to dive in just a moment, but I want to welcome our guest, Anthony. Welcome to the show.
Well, thank you, Whitney. I'm excited to be here.
Yeah, honored to have you on. And you are an expert in this topic of infinite banking and what is that, how to use it, and who should use it, all those things. We're going to dive into just that. But before we do, first I want to thank you for your service during the interview as well. I just appreciate that, as I do all our veterans. But give us a little more of your background. Moving this way, I know you self-described yourself as a recovering CPA, but let's move into where you're at today and your expertise.
Yeah, I would say I'm a self described recovering CPA, right? I've been a CPA. It's almost 30 years, but when I say that, it makes me sound so old. But I got my CPA when I was 10, right? But the reason why I use that is because a lot of times what I found when I had my CPA firm, what I was recommending people to do was these Wall Street products, right? Let's max out our 401k, or maybe we can open up a SEP, or again, it was mutual funds, right? But I learned really 2008, it was really eye opening to me. I found a lot of not only did I get punched in the gut, but so did a lot of my clients, right? And the problem was they would come to me as like, "Hey, Anthony, I did everything I was supposed to do, right? I maxed out my 401k. I paid off my mortgage. I stayed out of debt. Now my 401k is a 201k. What do I do?" And what I noticed is that there was a small select portion of my clients that actually thrived during that time. And that was really eye opening to me. And I approached them, what are you thinking? Right. Or really more importantly, what were you thinking that you were in a position to take advantage of these opportunities? So they opened up my eyes to a lot of books. I mean, one I'm sure a lot of your listeners have read is Rich Dad Poor Dad. To be honest, I read that many years before that, like many people, but also like many people, didn't do anything about it. I didn't put it into action. And this kind of opened up my eyes to real financial freedom, not just waiting until I'm 59 and a half, but I want to enjoy my time now. So this really got me on the journey of building my passive income to be more than our monthly expenses, which that is the kind of the tagline that we use. And what I like to say in short, passive income is short for PI. So I say, I want my pie to be bigger than me, right? That is my goal. So that opened up my eyes. But then I also got exposed to the infinite banking concept, which was this book, Becoming Your Own Banker by R. Nelson Nash. And so what I did is I started combining those two books and strategies together. And then then my clients, my tax clients would say, "Hey, Anthony, I don't trust Wall Street. I want to do something different. What should I do?" I'm like, "Well, this is what I'm doing." And I eventually kind of turned that into a business. And then I had both, had teaching IBC and then plugging out tax returns. And oh, and then I also had a family somewhere here off in the side. When I had to make a decision, which is an easy one. I sold my CPA firm and just started teaching people how to create passive income, particularly using the infinite banking concept.
When 2008 happened, you mentioned that your clients, including yourself, a number of them, you said were punched in the gut, right? But you said a portion of those thrived during that time. Was it because they were, or what were they doing, right? You mentioned you asked them, was it that they were using an infinite banking type method, or was it because they had their own businesses, or what was the differentiator there?
There wasn't just one thing, there was many things, but I think the biggest thing is they didn't have their money tied up or locked into a qualified account or a 401k. So when they found opportunities, I like to say that the better the opportunity, the smaller the window it is to take advantage of it. And so you need to be in a position of liquidity and being able to act fast. And I would tell you, 2008, there weren't that many people really doing the infinite banking concept. When I learned about it, I was kind of thinking this, like some of the comments that you had said before. Like, is this a scam? Does this really work? Why isn't everybody doing this? And I really took a long period of time to really beat down the facts. And I would go to the other financial planners. Well, why doesn't this work? And but nobody could really give me a solid answer. So I put my toe in the water and I started doing it. And it worked exactly like Nelson Nash had said. So then I ended up getting more and more into the infinite banking concept.
Nice. Well, I want to dive into that a little bit. Obviously, for our listeners, you had mentioned that before we started recording that a lot of clients are investing in syndications using the infinite banking method. So I know many of our investors and many others as well listen to the show, and I'm sure are have questions, right? And so I'm sure I'm going to have a number of questions, and I want you to feel free to elaborate on some things people ask all the time, especially as they're investing in syndications specifically using this method. But first, what is infinite banking? Is it a scam? How do we know it's not a scam? Answer some of those things and let's dive in.
What I would say is that people have a lot of questions and we want them, encourage them to do their research. Don't only rely on us. And one way we have helped people solve those or answer those questions is through education. And we have an online course. And at the end of the episodes, I give a free link to to your listeners where they can get free access and see for themselves without having to talk to me or to anybody else, right? But what I would say is with infinite banking, it's it really isn't that complicated. We have a tendency to make it complicated, especially with me, I'm a recovering CPA. I oftentimes get too much in the weeds and the details. But Whitney, what I would say is, do you use a rewards credit card?
I'm not a great example of that. However, I do have an employee that uses rewards to the
Mhm.
point that they go on trips for free everywhere they go and often. It's crazy. She's like learned this like whole system of rewards.
Yeah, there is like a whole system, but I would tell, but you can understand the theory, right, or
Right.
why
For
people would
sure.
use it, right? And but if you can understand that, you can understand infinite banking. Okay, but so I'll come back to that in a second. But really, what we found with most investors, they are setting money aside, or maybe they have a windfall of cash. But either way, as they're waiting for an opportunity, whether it's a syndication or whatever their asset of choice is, they have to store their money somewhere, right? Somewhere that's safe and liquid. Now, Whitney, where do most people store their money where it's safe and liquid?
In a bank account.
Yeah, in a bank account, right? Perfect. Okay, and then they store it there, and then when an opportunity comes, they withdraw the money, and let's say a syndication. So they invest in a syndication. That syndication, if it's a good one, will start paying some cash flow, right? Or maybe a sale, a windfall upon the sale. But either way, when you get that monthly or quarterly cash flow, it's got to go somewhere. So we put it back in the bank, right? And maybe we take some out for lifestyle or to enjoy, but we're typically going to keep some money in there because we want to buy more assets. And we do the same thing. We withdraw the money from the bank and buy the asset, take that cash flow and put it back into the bank. We call this the cash cycle of investors. What we're saying with infinite banking, we're not changing what you're doing. We just want to change how you do it, because all we're really talking about in the simplest terms is where you store the money. Instead of storing it in a bank that's safe and liquid, with infinite banking, you can store it in an account that we could argue is even safer than banks, that it is liquid. It's going to earn a much higher rate of return than banks. That return is going to be tax free. And depending on what state you live in, every state has some level of asset protection. Many states, money inside your infinite banking is 100% protected from creditors. Okay. But the biggest benefit is we have the ability, instead of when we withdraw our money, we're breaking the compound interest curve, right? Whitney, we withdraw the money and we stop earning interest on that. Now, Whitney, at what point do you want your money to stop earning compound interest? What would you say?
Never.
Right. Okay. Good, good answer. Well, with infinite banking, we never break the compound interest curve. And the way we do that, and the product we use is an infinite banking designed whole life policy. And believe me, I tell you, when somebody hears whole life, like when before I learned about this, alarms went off, right?
Yep.
High commissions, no cash value, terrible investment, blah, blah, blah. The way we design it, extremely different than that. Very different. In fact, we're trying to get the death benefit as low as possible, right? On what I call, you know, I say that this ain't your mama's whole life policy, right? Those typically have high death benefit, no cash value till year 3 or 4. This is the opposite. We have a very low death benefit and we have cash value from day one. We have people putting the money in, turning around and taking it out 30 days later after the account is set up. So all we're really trying to say is, instead of using a bank, instead of storing the money there, you store the money in the policy. And just like I mentioned, there's additional benefits in order of storing there. And there is a death benefit, but in our view, the death benefit is icing on the cake. All we're really trying to do, or really all this policy needs to do, is outperform where you're currently storing it. And it will easily outperform you storing it at a bank. And just like I mentioned with the rewards credit card, a lot of times we want to buy something, right? And we're going to buy it anyway. So, but instead of paying cash, we use a rewards credit card, or we just add that one extra step. And so I view my policies as my rewards credit card for my investments. Instead of adding that, I still add one extra step, but instead of a credit card, it's my policy. And instead of getting miles, I'm getting uninterrupted compound interest. Now, we can go into some more detail, and I'd love to answer them.
Yeah,
But
speak to the uninterrupted compound interest. If I take the money out 30 days later, how does it keep compounding? And then how do I access that as well? I mean, it was two different questions.
yeah, well, it works very similar to a home equity line of credit or a HELOC, which I know a lot of real estate investors do, where that equity inside their home really isn't doing anything, so they can leverage against it to 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 do some investments. Now, there is some interest due paid to the bank. However, assuming there's appreciation in your house, you get all the continued appreciation in the house. But how this is different, it was very similar and conceptual. The difference is, instead of using equity in the house, we're using equity inside your policy. And in addition, uh, one of the downsides of a HELOC is, if you want an increase, you have to ask permission, right? We have to get another appraisal and title insurance and do that whole thing. With your infinite banking, it's like an ever increasing line of credit that you never have to get approval for. And when you take a loan, here's the interesting thing: insurance company takes all these premiums and they have to invest them because they want to make sure that there's enough death benefit or enough cash to pay the future death claims. So they have to put the money to work. One place they're going to put it to work is policy loans. They will loan you against the cash value of your policy. And when they do that, they don't run your credit. They don't ask you what it's for, or they don't ask you how you're paying it back. All they are going to ask is, how much do you want and where do we send the money? And the reason being is, from their point of view, this loan, on their view, is fully collateralized. It's literally, they're fully collateralized against the cash value of your policy. They're literal. They will get paid. Either you surrender the policy and they take the money from the surrender value, or they're literally wait until you die, and they will take that off of take that off of the death benefit. And the interest rate that we pay the insurance company, because the way this works, they just use your policy as collateral. So that loan, just like a HELOC, is against your cash value. So your cash value is gonna continue to grow, and we are paying interest. However, that interest, when we use it for a syndication or for an investment, or when we use the money to create taxable income, we can deduct the interest against that taxable income. So what I think is very interesting is, this is the only strategy or asset I know that isn't a give and take. I mean, for example, you take an IRA, you put money in an IRA, you get a tax deduction, but when you pull it out, you have to pay the tax. Or, I mean, it's always a plus or minus. But here, you're getting the plus of the growth of your policy tax free. But when the interest you pay to use that money is tax deductible. So you get some tax advantages there. And now when you overlay it with the tax advantages of real estate, that's where I feel you're truly taking advantage of the tax code.
Are you like the pass through depreciation from an asset, or is that are you still able to use that, or is that would that go towards this policy in some way?
Well, you know what, it would be the interest you pay the insurance company can be used similar, like the interest you're paying on your mortgage, on the mortgage of the property. Or if we do a syndication, you're getting a K1. Well, we can deduct this interest as investment interest expense.
When are you taxed on it? Or, like, when is this money finally taxed?
That's the beauty. as long as you keep, there's special tax advantages of real estate. I'm sorry, of life insurance. And as long as that policy is in force, the loans you take out are tax free. And eventually, again, this is whole life. It's not term. So the death benefit is going to pay out. It's not a matter of if, it's a matter of when. But what'll happen upon when you pass away, that death benefit will pay off any loans that are outstanding, and the difference, the remaining amount, will go to your family tax free.
Okay. Yeah, I was just thinking. So the amount that would still be in there, or you said it would pay off your loans. It'd be a significant amount, though. I guess that would be your death
It should be,
benefit.
yeah. I mean, hopefully you're using it and creating some more income. Our goal isn't just to let money sit, right? I mean, if we need to in between deals, the best place for it to sit and the safest place is inside a whole life policy. So I tell you, for me, I'm using my money. I keep some money in reserves and some money for opportunities, but anything else, I want my money working. I want to buy real assets, and in between those purchases, I got to store them somewhere. So I store them inside my policy.
So speak to like being able to use it. I mean, let's say something happens, your kids get married, right? And you need to take out, you need to
Yeah.
use it for some kind of personal expense like that. Is it always a loan? What does that look like? And then also paying it back.
Well, I tell you, you can use it. We say you spend money on one of two things: an asset or a liability, right? Asset brings money to you, liability takes money from you. So infinite banking works for both. I have a daughter and she will eventually get married, and I'm going to be on the hook for it. And I know that. I intend, again, I'm not going to have cash sitting around somewhere. I'm going to store it in my policy. So when she does get married, I got two options. I could take a withdrawal from my policy. The advantage to that is I don't have to repay it back, and there's no interest accruing. But the downside is I broke the compound interest curve. The downside is I can't put it back, and I stopped earning interest on it. So ideally, under most situations, we recommend somebody to take a loan against a policy when they want to use it. Then how they pay it back, again, there's a lot of different ways to do it. If it's something like this where you're buying a liability where you are repaying the loan, then I'd recommend maybe setting some sort of, either using a repayment schedule. Hey, I'm going to put $500 or $1,000 a month to pay it back. But when I try to use my policy for assets, and in part, and I'm trying to create more passive income, but also that way I'm not repaying the loan, the asset is. So I have the asset predict how the money is going to be paid back. I've done some assets that pay me monthly. So monthly I put some money back in the policy, but I have some that are quarterly, and I have some that were supposed to be quarterly but haven't paid in a quarter of a few years. So I'm not paying it back. But eventually when I do get paid back, when that asset is sold, I'm going to get that windfall. I need to put it somewhere, so I'm going to that's when I'm going to pay it back.
What's the risk?
Great question. I would say that there's a couple, and there's pros and cons to doing everything.
Sure.
Infinite banking is no exception, which is why we make our clients go through an education process, so they know the highlights and also the not so highlights. What I would say the risk is, depending how we design it, the first few years you put in a dollar, you might not be able to use a whole dollar. So there is a loss of liquidity there, and we're going to be very transparent. So what we tell people, if we're focused on short-term results, either infinite banking's not for you, or maybe we need to put in a lesser amount or some amount that we can focus on the long term. And I, I would say another risk is that it can be very tempting not to repay the loan,
Mm,
right? Because they're not hitting your credit. They're not going to call you and say, "Hey, Whitney, you haven't made a payment." There is no third party enforcing you to repay it. But and I will tell you, full disclosure, first policy I got, I took a policy loan and I paid off my car note. And what I should have did is just redirected my car note back into my policy. But to be honest, I didn't. I got a little lazy. But then eventually I realized that I'm only cheating myself.
mm.
And then I started repaying myself. Then I realized, wait a minute, when I made my car payment to Ford Credit, I never saw those dollars again. But when I put it back into my policy, I just took it from one account I own and control into another account I own and control. So I never lost control of those dollars. But because of that, that's why we think it's important that you're working with somebody who really understands IBC and is actually living IBC. Because to be honest, anybody could sell you a whole life policy, but the key thing is one is the design. You don't want like a policy like your mama's whole life. You want one that's going to be a high early cash value. And also, you need some coaching in there to make sure that you can utilize it correctly and to make sure you're staying on track.
What happens if you don't pay?
Great question. If you don't pay, then that interest just gets added onto the loan. And there could be, I would tell you, there's a lot of IBC people out there, and some are doing it right, and many are not. And some of them will explain that it is acceptable to do that because the power of compounding, it can be greater than the interest. But I do not condone that. I've done the math, and I don't think that that is correct. But what we do need to do, we need to have a plan. What happens if if I can't repay the loan? Well, what we can simply do, we have to figure out, is this a temporary problem or a long-term problem? Because the temporary problem, if it's a long-term problem, then we need a long-term solution. And that would be is we can call the insurance company, say, "Hey, that loan I took for 50 grand, instead of a loan, I want you to take a withdrawal and pay off that loan." So it's done. There's no loan, no interest accruing. But the downside is we did break the compound interest curve. But if it's a short-term problem, then we just need a short-term solution. Because I've done some deals where I did an investment and I never saw that money again. But I knew that eventually I would be able to recoup and make that money from another investment. And I'm gonna need a place to put it. So what I do is I pay the interest each year for two reasons. For one, I w- I want the tax deduction, but I can only get the tax deduction if I pay it. But then two, I ideally don't want that interest compounding. I don't want to pay interest upon interest. And then eventually, as I as I get money, whether it's a big windfall or some small ones, or maybe my kids are out of the house, and now it's amazing how my cash flow has increased since then. I need a place to put it. So maybe I chip away at that loan at that point.
What's the or I guess, how often does somebody come to you and just say, "You know what? This is just not for me. It's not what I thought it was. I just would rather have my money out of this and do something else."
To be honest, it's rare. And I think in part that's why we have a thorough education process.
Yeah.
You're gonna see the numbers, and we're gonna point out uh, the bad things about infinite banking. We're gonna make sure you understand them and why. And when somebody understands it, they don't view their insurance premium as a payment, because a payment is money going to somewhere else. They view it as a deposit, right? And so when do we want to stop having deposits? I mean, hopefully never,
Right.
right? So we kind of view this differently. And and I will say sometimes people understand it, but you know what? Circumstances change. Maybe there's a divorce,
Right.
or a disability, or just something extreme. And sometimes they can't afford it anymore. And then we have a lot of options. Probably one, you could cancel the policy, they give you their cash value. You can actually sell your policy to somebody else, which I've done a few times, which is a great opportunity. But you know what? We can also turn these premiums off.
Mm.
We're kind of doing a whole life. So we kind of design it so you can deposit premiums your entire life, but things may change. Whether maybe it's when you're kind of winding down and maybe don't have as much income, we could turn premiums off. Or maybe you're like, hey, man, I don't like this anymore. Or, man, my income has really gone down. We can lower the premiums and all the way down to zero. So there are going to be some options there.
Yeah, if we're talking about somebody that is a passive investor, maybe they've invested in a few deals. Who in that realm is this not for?
I tell you, this is not for somebody who wants to take a passive approach to their education. We're going to make people go through our process, and they're going to hear me or my business partner or one of our coaches speak and draw this out, and we're going to show you numbers, and we're going to do a case study. Hey, let's buy the syndication in cash, or what if we buy the same syndication through a policy? And we're going to show you who has more money, and more importantly, why. And so if somebody's not willing to go through the education, or they're not willing to take action, then we are not a good fit for them, nor is infinite banking.
Yeah. What about, is there maybe a simple way where we could, I know we don't have a ton of time left, unfortunately, but maybe you could give an example like that?
An example like what?
Like you mentioned there, some kind of a case study or just a thought provoking exercise to think through somebody doing it versus not.
Okay. What I'll give you a little summary of the advantages of when we're using infinite banking. We never break the compound interest curve. So when you have using a savings account, you're earning. Well, most investors are earning less than 2%, right? Or maybe zero. Or maybe right now interest rates are a little high. So maybe they are earning a little bit higher, but over the long run, they're not really earning a lot of interest. But inside the policy, not only are we earning more interest, but we never stop earning that interest. It continues to compound. And a prime example is, let's just say one investment that I buy a lot of single family homes, and I get a 30-year mortgage, and whatever I need to come with at the table, the down payment, it's got to come from somewhere. And what I do is I will take a policy loan for my down payment, and the cash flow from that asset will repay the loan. Things go well, it might be a little less. Not so well, it might be a little longer. But the thing is, I will eventually repay that loan. And because we never withdrew the money from the policy, my cash value continued to grow. So that, and let's just say for talk purposes that my cash value is going to grow, say to be in 10 years, be $100,000. It's going to be $100,000 whether I use it or not. But by leveraging against it, I still not only have that $100,000, but now I also have a cash flowing asset. So you know what I do? Well, hit the repeat button, and I buy another asset and another asset. And so eventually, well, really, if you're following our teachings with infinite banking, I know a lot of people get caught up on the policy numbers and the cash value. Again, that this is just where we're going to store the money. If we're doing this correctly, we should have more assets but outside the policy by leveraging it against it than we do inside. And so again, that's another reason why I say that the policy is like a rewards credit card, is because I'm going to buy those assets anyways, right? But by running it through the policy, I'm going to build up this uninterrupted compound interest of cash value inside my policy, and I can turn that in to tax-free cash flow whenever I want. So that I'm going to have these assets anyways, But by adding this one extra step, the infinite banking, I'm going to have this tax-free cash flow from the policy, which I equate to my travel miles from my rewards credit card.
Now that's helpful. I think it's helpful for the listener to think through that as you talk through it. One thing I wanted you to mention, and you briefly went over it earlier, but is the terms of the loan and how that's created and on who gets to decide that.
So where the loan is from is there's a couple ways that we can access a policy loan uh, or the cash value. Typically, we would use we could borrow the money directly from the insurance company, and it's like an interest only line of credit. Now, the repayment of the terms are extremely open, meaning there is no required repayment. On the anniversary of your policy, you're going to get a statement. Hey, Whitney, you took a loan for 100 grand. Interest due is X. Again, we recommend that you pay it so you can get the tax deduction. But sometimes we're not in a situation where we can pay it. And that's okay. They're just added on the loan and you can just repay it at a future time. Now, another strategy that we do is what we call, as I mentioned, we're all familiar with the HELOC. We call this a LELOC, a life equity line of credit, where we can borrow from banks and they use your policy as collateral. And the biggest advantages of this is now I have checkbook access to my cash value. So when I need to do a deal, I can just write a check. If my business needs some money, I can write a check. And even the last asset I bought about a month ago, I called up the bank with the LELOC, told them to wire the money, and they had the money in the other account by the end of the day. So it was extremely liquid and I have that access. Now, Winnie, you had mentioned one thing that we got to talk about in terms of loan is going to be the interest. Now, that will vary a little bit between insurance companies, but right now they're really between 5 and 6%.
Okay, that's helpful. I'm sure that was a question that some people had just about the interest rate they could expect, no doubt about it. Anthony, unfortunately, we're running a long time. But what else? What are some burning questions that people have when they're starting this that maybe I don't even know to ask you? That myths you could dispel either way before we move to a few final questions.
Oh, perfect. I would tell, like for me, when I went to, like I mentioned, I went to other financial planners. I went to mine when he's like, they're just earning high commissions, right? Now, isn't that what we hear a lot, especially if you're listening to Dave Ramsey, which probably a lot of your listeners are not, but I would imagine. But the way we design it again is very different. We're actually taking a huge pay cut on the commissions. If you were to get a policy the way we design it, or maybe your brother-in-law or uncle can sell you a whole life, he will make literally 3 times more than we do for the exact same premium. So that is probably the biggest myth out there. And again, some people might say, well, I could earn a higher rate of return doing syndications or doing something else. As well, you should, right? We don't view your policy as an investment. This is a high yield savings account. We only want to keep the money there when we don't have a job or a job for it. But again, this isn't an either or. Put it in life insurance or real estate. This is an and asset where you have the ability to do both.
Anthony, what are some of the most important metrics that you track? Could be personally or professionally.
I tell you, for me, again, if focus on your goals. For me, I'm looking at my passive income is my main number. I'm also looking at my net worth, and I'm also looking at kind of the number of the amount of real estate I own, because I'm not just looking at focused on what that value is today or what's going to be in the future, but I know typically real estate is going to increase with inflation. So if I can get $1 million of real estate today, uh, I know in 20 years from now, it'll be worth a lot more than that. But I believe it'll be about the equivalent of $1 million in today's dollars.
What about some habits that you were disciplined about that have produced the highest return for you?
I would say the biggest one is valuing my time. So it's not really an investment, but it allows me to focus on things that are the most high value. And it's giving me the freedom to outsource or hire people to do things that are either low value or stuff that I just do not like doing. Like I love teaching about infinite banking. So I have the ability to try to do this as much as I can. Not only is it productive for the business, but I truly enjoy doing it.
Can you give a couple tips on your process for doing that?
I would I've just read this. There's many books out there
Right.
about it, but one that I just read was how to buy back your time. And what the author was talking about, a lot of times people hire to scale, and I want to grow, so I want to buy more. I want to hire more salespeople, right? Because I want to generate more money. What he talks about is we want to buy back your time. So either we hire people to free up your time so you can spend that time by either focusing on high value activities, or also a lot of times a lot of entrepreneurs forget about some of the important relationships that they have. I mean, I know I did that when I was building my CPA firm, had tax season. I had these young kids, and a little interesting story, Whitney. My daughter said, and I think it was in first grade or kindergarten, that there's 5 seasons: spring, summer, winter, fall, and tax. Like my daughter thought tax season was like one of
I
the
see.
five
Yeah.
seasons, which a little bit funny, but also a little bit sad that daddy's not around during tax season. So I tell you, for us, it's really about the quality of having the life you want to live. It's not all about having a lot of money. I mean, it's about being able to do the things that you enjoy. More money will provide more opportunities, but you know what? We want to make sure that we don't focus so much on money that we forget about the important things.
Hmm, for sure. How do you like to give back?
What is interesting, what I like to give back is with some of the clients that or people that call in. Like we have a discovery call, 15 to 30-minute free consultation. And sometimes people will call in and they're just not, eh, as much as I love about IBC, it's not for everybody. So sometimes people need some financial guidance to get them out of a hole. So I think some of the area of expertise I have with taxes and with managing money, I have the ability to be able to give them some resources that they need in addition to even though we're not being compensated. And I also have a passion for kids, so I like to volunteer, in organizations that support the homeless youth.
Awesome. Well, I appreciate you mentioning that and giving back in that way. Appreciate the way you giving back to us today, Anthony, and really talking through infinite banking. What is that? Some of the things that people, reasons people might think it's a scam, why it's not a scam, how it works, even giving an example and thinking through investing in syndications using this model. So you don't break that compounding cycle, right? And which we all know we'd rather not ever break it. So Anthony, how can people get in touch with you and learn more about you and your course you mentioned?
Okay, we our company's name is the Infinite Wealth Consultants. So you can so we have a website, and that's our handle on all the major so, social media platforms. We do a lot of stuff on YouTube, and we do a lot of live streams there. We also have a podcast, the Infinite Wealth Podcast, which is kind of half infinite banking and then kind of half ways to create passive income. And I know your listeners, some of them are like, man, I don't know about this. Right. And all what I would encourage you to do is learn about it. Maybe it's for you, maybe it's not, but I think it's important for enough for you to at least spend, say, an hour of your time we're giving you free access to the course. If you go, we have a little section there called IBC 101. That's going to give you a big overview of whether IBC is going to fit with you or not. And if it's not, then no harm, no foul. We're not going to chase you. We're not going to call you. But if it's something for you, you probably got some questions. So you can reach out to us. We will answer those questions, and we'll explain the good things about IBC and also the not so good things about IBC. And for your listeners, for our course, we typically charge about $500 for it. But for the listeners, if they use this link, you're gonna get free access to it. And the link is infinitewealthconsultants.com/the real estate syndication show. It's kind of a long one, but I thought it might be easier to remember. And I'm sure Whitney will include that in the show notes.
We will. I appreciate that very much for the listeners and myself, and grateful for that. I do agree, Anthony, about the often we need more education, right? Before we shoot something down. So no doubt. I think too, even as operators are listening, it's we often need a place to even send investors so they can get educated, right? And so I appreciate that resource.
My pleasure, Whitney. Again, thank you for having us on.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.